You hear it literally every single day, right? You turn on the evening news or check your phone, and the headlines are always screaming the market is up today, or the Dow dropped 200 points. We kind of just treat these numbers like the weather, just a basic fact of daily life. But what exactly are these numbers? How are they calculated? Who decides what actually goes into them? And how do they manage to govern the trillions of dollars flowing through the global financial system? Well, welcome to this explainer on the evolution and mechanics of security market indexes. Today, we're going to completely demystify the yardsticks of the financial world. Let's dive in. So here is our roadmap for the explainer. 1. What is a market index? 2. Price return versus total return. 3. The 4 weighting methods. 4. Rebalancing and reconstitution. 5. The uses of market indexes. And finally, 6. Exploring different index types. We're going to move right from foundational definitions straight into the mathematical construction and then to practical real-world application.
All right, Section 1. What is a market index? Crazy enough, investors actually had access to regularly published data on individual security prices in London way back in 1698, but for nearly 200 years, they didn't have a simple unified indicator to just tell them how the overall market was doing. That finally changed in 1884 when publishers Charles Dow and Edward Jones introduced the world's very first security market index, the Dow Jones Average. Now, at the time, it consisted mostly of railroad stocks, but Charles Dow was incredibly observant. He realized that industrial companies, not railroads, were going to be the great speculative market of the future. So in May 1896, they launched a second index, the Dow Jones Industrial Average, starting with an initial value of just 4094.
And that brings us to our core definition. A security market index is basically a tool representing a specific security market, a market segment, or an asset class. You can just think of it like a hypothetical portfolio of marketable securities. The value of this index is calculated on a regular basis using the market prices of the individual securities, which we call constituent securities, that make up the index. It's a single, consolidated measure that saves investors the massive time-consuming headache of analyzing vast amounts of individual data.
Moving on to Section 2, price return versus total return.
Okay, this is absolutely crucial. For almost every security market index out there, 2 versions are calculated, a price return index and a total return index. A price return index measures only the price appreciation or depreciation of the securities. That's it. But a total return index measures the price appreciation plus the reinvestment of all income, like dividends or interest received since the index started. Now, on day 1, both versions have the exact same value. But as time passes, the value of the total return index will blow past the price return index by an ever-increasing amount. That is the compounding power of those reinvested dividends at work.
Next up, Section 3, the 4 weighting methods.
Once an index provider decides which target market to represent and actually picks the securities, they have to make a massive decision. How much weight should be allocated to each security? This weighting decision is essentially the recipe used to bake the portfolio, and it has a huge impact on the index's final value. Today, we mostly see 4 primary methods: price weighting, equal weighting, market capitalization weighting, and fundamental weighting.
Now, you might be wondering, if 2 indexes hold the exact same 50 stocks, does the weighting method actually change the return? The answer is a resounding yes, because the recipe dictates how much of your hypothetical portfolio is allocated to each stock. A stock that doubles in price will have a massive impact if it makes up 20% of your index, but it'll barely make a ripple if it only makes up 1%.
Let's break down the specific biases of each recipe. First, price weighting. This is what the Dow Jones Industrial Average uses. It bases the weight purely on the individual share price. Honestly, it's incredibly arbitrary. A stock priced at $100 has 10 times the influence of a stock priced at $10, completely regardless of the actual size of those companies. Next up is equal weighting. This simply gives every stock the exact same starting slice of the pie. The bias here? It ends up overweighting small-cap stocks relative to their actual footprint in the economy. Then we have market capitalization weighting. This is the big one, the most common today, used by the S&P 500. It weights a company by its total market value. But this creates a momentum tilt. As a stock's price rises, its market cap grows, and its weight in the index increases. You are effectively forced to buy more of the stocks that have already gone up, which can totally lead to overweighting overvalued companies. Finally, fundamental weighting. To counter that momentum tilt we just talked about, this method weights companies based on economic footprint metrics, things like earnings or book value. This introduces a contrarian or value tilt. If a stock's price falls but its earnings stay strong, the fundamental index actually buys more of it.
All right, Section 4, rebalancing and reconstitution.
So the key takeaway here is that indexes aren't static. They require management, which comes down to two major events: rebalancing and reconstitution. Rebalancing means adjusting the weights of the securities to maintain consistency with your chosen method. For example, in an equal-weighted index, as prices move around every day, the weights quickly become unequal. So, usually on a quarterly basis, the provider has to sell the winners and buy the losers to reset everything back to equal fractions. Reconstitution is a much bigger deal. This is the process of changing the actual constituent securities in the index. The index provider reviews the market, drops companies that no longer meet the criteria, maybe they went bankrupt or their market cap shrank, and adds new ones that do.
And this perfectly illustrates the real-world impact of reconstitution. Take a look at this massive volume spike in Uranium Energy Corporation, or UEC stock, back in 2009. The Russell 2000 index reconstitutes annually. Well, months before the official change even happened, active fund managers began anticipating that UEC would be added to the index. They started aggressively buying the stock, which dramatically drove up its trading volume and price before the reconstitution was even official. It's wild. It just shows how index mechanics directly move real markets.
Move into Section 5, the uses of market indexes. So, what are we actually using these things for? Well, indexes serve a few critical functions. Originally, they were really just gauges of market sentiment, a quick vibe check on investor confidence. But today, they are essential proxies for measuring systematic risk and return in complex financial models. They also serve as incredibly strict benchmarks for actively managed portfolios. Think about it. If you pay an active fund manager high fees to pick small-cap stocks, you don't compare their performance to the broad market. You compare them to a specific small-cap index to see if they are actually earning those fees. Finally, indexes act as the literal blueprints for passive investment products like index funds and exchange-traded funds, or ETFs.
And finally, Section 6, exploring different index types.
Let's zoom out and look at the global landscape. At the top tier, we have developed markets indexes. Providers like MSCI group the most established, highly liquid, and economically advanced nations together. We're talking the United States and Canada, much of Western Europe, like the UK and Germany, and Pacific nations like Japan and Australia. We often get hyper-focused on just the US stock market, but these indexes map out a massive, diverse global financial landscape.
The next tier down? Emerging markets. These are economies that are rapidly growing and integrating into the global system, but they might not quite yet have the full market accessibility or stability of developed nations. This index captures major dynamic players like Brazil, Mexico, South Africa, India, and China.
And then you've got the frontier markets. These are your smaller, less accessible, developing economies. This category captures countries like Argentina, Kenya, Kazakhstan, and Vietnam. By categorizing the world into these different buckets, investors can use specific multi-market indexes to precisely target exactly what kind of geographic risk and return profile they want.
But hey, quick reminder, indexes are absolutely not just for stocks. The massive fixed income world relies heavily on indexes categorized by bond issuers, maturities, and regions. There are commodity indexes measuring everything from gold to agriculture. You've got real estate investment trust indexes and even hedge fund indexes that try to track the performance of really complex alternative investment strategies. The whole concept of the index has expanded to cover literally every corner of the investable universe.
So as we've seen throughout this explainer, an index isn't just some passive number floating in the ether. It is a highly engineered portfolio built on very specific mathematical choices. And those choices create distinct biases that drive massive market behavior. So the next time you look at your 401k, a pension plan, or your personal brokerage account, consider this. Is the index your investments are tracking or being benchmarked against built with the right recipe for your specific financial future? It's a question every single informed investor needs to be asking. Thank you so much for joining me on this explainer. Keep questioning the numbers, and I'll catch you next time.